New Year to everybody. Thanks for coming on. I guess, it's just, kind of keep this very open-ended, ask questions to jump in terms of structure. Aaron, if you maybe want to just kick it off, talk a little bit about your portfolio and some of your projects and, including the ones that you already have. And, this is that time of the year where we're all getting our updates and K1s and those type of things. So if you want to talk a little bit about your performance last year.
Yeah, well, thanks, Jerry. And first, just appreciate all your support over the years and the friendship and stuff like that. So that's been really cool. And yeah, I probably spoke to most of the people on the call before, and just want to say thank you to those who have invested with us and trust Dan, Brian, and I to take good care of your money. So we really appreciate that. And yeah, I can kind of, I don't know what you want me to do, but I can kind of run down a few of our deals and kind of let you know where we've been relative to performa. And Dan, if I miss anything, please step in. And the one thing I would say about investing is sometimes on deals, everything goes perfect. And other times, maybe things don't go quite as well, and you have good expectations about all of them, but it just seems sometimes some perform really well, others maybe not as well. Thankfully, all our deals are performing. They're secure. We're paying distributions. They're cash flowing. They're meeting pro forma, but some do significantly better, and others were right at pro forma. And sometimes it's hard to predict which are going to excel and which ones we're just going to meet pro forma. So the first deal we did was Carolina Commons, now named Cottages at Staunton Bridge. Acquired that May of 2021, and our 2024 actual profit and loss year to date, Dan calculated the numbers at 29% above pro forma. So that one we bought May of 2021. And if you can recollect back, that's kind of right about when inflation really kicked off and rents were really accelerating. And so the timing was good, and that property has performed very well. The second one we bought was December 2021, Towns at Summit. And that one has been a little bit more difficult. I can say we are at pro forma on that deal. It's been a little bit heavier lift than maybe we anticipated, and Brian and his team has really had to do a lot of work, both with improving the tenancy and some significant renovations where we're probably spending 20K a door renovating these units, 30 units. And I think, Brian, you've probably done 24 or 25 at this point.
Yeah, we're up to 26 as of this week. So
right. And with that, we're right at performa. And I can tell you we underestimated insurance. When we went in to buy the deal, insurance was 14 a year. The last premium was 24 a year. We estimated repairs and maintenance at about 15 a year, and it's now about 25 a year. Fortunately, we overestimated property taxes by about that delta, so we're right on pro forma. So inflation has raised expenses on some of these deals, and Brian can speak to increased material cost, increased labor cost. It's just kind of the way it is. And of course, I think most of us are aware that insurance premiums have increased dramatically, but we've made it up elsewhere, and we're on pro forma with that deal. So very happy about that. And then more recently, I think we're all kind of aware there's been a disconnect between seller expectations on price and what buyers could pay with higher interest rates. So we then switched to some new build property where basically we're buying duplexes from builders at completion. We're not involved in the entitlement. We're not involved in the construction. They finish the unit. We close within 15 to 30 days after. So Dan, maybe you could run through kind of where we've been at with the Greenville new build portfolio one, and then Towns at Wolford Pine and the silos, which have all been new construction. And then maybe we'll circle back to our most recent acquisition, which is kind of a heavy value add in Greenville.
Yeah, sure. Okay. Yeah, the Greenville new build portfolio, we closed on that 23, right? Yeah, 2023. And that's comprised of 8 duplexes at one site, 12 in another. The gross numbers last year, we were about 9% shy of pro forma. However, one of the biggest impacts to those numbers was the Hurricane Helene came through, knocked down a bunch of trees. We had to spend about $14,000 to clean that up. And so if you take away that kind of unplanned expense, we were at -3% of pro forma. So basically very within spitting distance. Our expenses have been pretty spot on to what we projected. Vacancy's been nominal. You know, Brian keeps a lot of people in these units, very low vacancy. There's a bit of a delta maybe on the projected rents to what we're getting. We started out, we needed to discount some units to get them leased up quickly. We are seeing upon renewal that these leases are going up 50 to 75 bucks each. So there's a slight variance in rate versus what was projected and what we're renting at. But overall, I'd say it's, again, if you take out the tree repair, unplanned, we're almost right on to pro forma. So that's kind of the high level 2024 performance for those duplexes. And then we closed 2 other deals right last year. The Towns at Wolford, which is 26 units, 13 duplexes out in Taylor's. The first year is always a little bit iffy because you have some one-time costs, right, that aren't in the pro forma. You got legal costs and you got, you know, appraisals and you got lender costs and things like that. But we were 10% negative. This was just a partial year, like five months before the end of the year. Negative 10% to pro forma. Again, there's some startup costs in there, and we had the Hurricane Helene situation, $17,000 in tree repair. If we take out that unplanned expense, we were essentially right at pro forma, within 0.5% above. So again, I think it's nice to be close to pro forma. The good thing about these, I wanted to mention, the good thing about these new units, right, is that there's a lot more cost certainty on the expense side. You don't have deferred maintenance. So I think that's why we're able to really hit the expense projections right on, because when you buy new units, you have to make a bunch of repairs. So that's the Towns at Wolford. The Towns at Silos, we owned a little bit less, about 5 months. And there's a similar story there in that there's, it took a little bit longer to lease up. And some of the rates that we leased up at to get them filled quickly was a little bit below, maybe $50 to $100 below in a couple of cases on those leases. But we're negative 17%. These are small numbers. Pro forma was 44,000. And net income, we came at 36,000. Because again, this is just a partial year, and this is 10 units. If you take out this kind of the startup and one-time costs that I had referred to, all the costs that it takes to kind of get the deal to closure, we would have been at negative 2% pro forma. So I expect next year we're going to be very close to pro forma, as upon renewals, we're able to lift the lease rates, and the expenses have been very steady. So that's the Towns at Silos project.
Well, thanks, Dan. And Brian, you might share a little bit about the tree damage you had to clean up at Towns at Wolford and out at Lyman, which is part of the Greenville new build portfolio. No buildings were hit, so this was just simply removing the trees and so forth. But that it in and of itself was a monumental job. So Brian, maybe kind of share, because you spearheaded that.
Yeah, so obviously I think everyone knows the hurricane came through, and it was kind of a very similar story at both properties, where I know not everyone's been out to the properties, but I know a few of you guys have. Both of these properties are pretty large parcels of land. I think Lyman is 4 acres and Walford 6 acres, and it's the vast majority of it's clear, but then we have like a wood line on either side of the end of the properties. On both of them, it's the same setup, and those wood lines were filled with a whole bunch of skinny, tall pine trees that snapped like twigs. So when the hurricane came, it essentially just knocked over. I mean, don't quote me on this, but I want to say it was somewhere around 30 trees at Walford, and somewhere between 35 and 40 in Lyman. And I mean, I remember driving over to Walford after a couple days after the hurricane is when I finally made it over there. And I almost had a heart attack when I pulled up because there was so many trees on the ground. But when I started walking around, I was pretty relieved because it was like a miracle. None of them hit the buildings. I mean, it was just unbelievable. So, needless to say, it was still a tremendous undertaking to get these all cut up and brought out to the road so that the county can haul them off from there. So,
And most of these trees were what, probably 30, 50 feet tall. I mean, they weren't dinky little trees, right?
no, yeah, these were good sized trees. Over at Walford, we even had, I'd say at Lyman, most of them were probably like that 30 to 50 foot range. But over at Walford, we even had a handful, probably about 5 or 6 of them that were like probably more like 80 to 100 foot, some pretty big ones. And so again, all things considered, hey, we got pretty lucky, and it's all cleaned up, it's behind us, it's part of the deal. So we're done now.
Yeah. And out at the Greenville new build portfolio one, particularly at the Lyman property, 12 units. And we closed kind of late 2023. So most of those leases have now come up for renewal. 11 of the 12 residents renewed. We got a $75 rent bump from the initial rent, which then basically puts us at pro forma. And again, on these assets, we got fixed rate debt. We basically got another 4 years to go on them. And the beauty of the new construction is it's kind of a long-term play. And so even if there's a little hiccup right at the beginning, we still really like the long-term kind of potential of this new construction. And we're actually looking to buy more of it. There seems to be an appetite of it. And we're talking to one builder, and maybe come spring, we'll have another kind of new build deal out in Taylor's that we can present to people, because Towns at Wolford Pine has gone very well. The other two have gone well too, but there seems to be a real demand for stuff in Taylor's, which is a little closer to Greenville than, say, Easley or Lyman.
So I have, I guess, a follow-up question on the portfolio, and then, maybe one a little bit more macro, and then we can get into, just the markets and stuff. Maybe there's more for Brian too. Like in terms of renewals, how do you determine, what kind of increases you're looking for? Is there depending on each project, obviously, but is it 50 of 100? Somebody comes back, says no, you settle. I guess, how are you determining, what these leases are renewing at?
Yeah, so whether it's for the multifamily properties or anything else that we manage for that matter, when we have renewals come up, I mean, we're going to go out and we actually stop and look at each and every single one of these individually, and we take a look at first of all, like because we manage so many properties, we have a good idea just roughly what the market's doing, right? Like we have a pretty good idea of what's going on in the market and what we can actually do or not do. In addition to that, we stop and then we're going to look at comp. Sorry about that. You didn't hear anything I said? No.
We heard the start. We heard
Okay.
the start. Yeah.
So So then we do all that. We come up with and also too, like with the multifamilies, I'm definitely kind of cross-referencing the pro forma and go, all right, hey, are we on track, or can we get there? And that plays into a little bit too. I mean, obviously we're doing our very best to keep up with pro forma expectations, right? And then yeah, so then we determine what we're gonna go out and ask for. And so kind of the way it works as far as like is it in regards to negotiating. Um, so we do that every month, and that's myself and my director of property management, Weston. We kind of work on that together, and then we hand it over to our leasing team, and I'll tell them if there's any wiggle room in there. So usually what I'll do is kind of hand them the list and go, all right, hey, if there's any pushback on XYZ property, let me know. We don't want to scare anyone off type of thing. And sometimes it's like, no, there's not going to be any wiggle room here. This is what we need to get. And that's kind of about it. And, again, we're just trying to again, I'm very, very hands-on in my business. I'm in my office every single day. This is very fluid. Things are changing constantly. And, hey, if it's January, and we have 4 renewals at one apartment complex, we might be a lot, more likely to negotiate versus it's June. We have, no vacancy, right. That type of thing, so kind of try to use a lot of common sense too when we're doing this, so there's just a lot of different factors, and we kind of just tie all them together, and that's kind of how we do it.
And portfolio wide, if I remember, you have about a 75% renewal rate. Is that what I remember?
Yeah, I actually have a spreadsheet pulled up here from last year. I'll go over a couple numbers real quick. So our average percent of increase for a whole entire portfolio last year was 4.38%, right? We had 72.05% of our tenants renew leases, and 27.95% of them moved out. So, and that's across about 550 properties. So, yeah, so right about 75% with a 4.38 increase in rent rates.
In theoretically a down market, right? It hasn't been boom for rents in 2023 and 2024.
Correct.
So even in kind of a down market, we're still getting increases on renewal.
Yes. Yeah.
Yeah, I mean, it seems like it's art and science both, Brian. So, I mean, the other thing to mention is, there's obviously new Class A stuff being built in Greenville and elsewhere. That's stuff that rents for over 2,000. And if we were competing against that stuff, there may be, concessions and different things that have to be considered. But at least from our portfolio, these properties we talked about and the JV stuff that we didn't talk about, but that you manage as well, typically at a lower price point, 1,500, 1,300, 1,400. Those are probably rents that can still go up versus if you're at the higher end, and then there's a bunch of new stuff going in. So there's all these different sub-market dynamics that Brian's got to contend with, right?
And I think the other thing, and Brian, correct me if I'm wrong, part of your assessment is, are these tenants we want to keep, or are these tenants we don't want to keep, right? So we try to improve the tenant quality, and that kind of impacts our renewal decisions too.
Of course, yeah. There's some times where an example would be, so we are just now, if anyone that's involved in the Walford deal remembers, we were able to negotiate where we were able to start pre-leasing the units at Walford while the builder still owned them, even though we didn't close till June. We actually signed our first lease in February last year over there. And ironically, the first tenant we placed over there has been she's paid rent every single month, but she's been extremely troublesome. So we did not offer her a renewal. We actually sent her a non-renewal of notice because, we have 25 great tenants over there, and we didn't want her affecting the other tenants anymore. So we didn't even give her an option to renew her lease. So yes, there are definitely, it's few and far between that, we do that. Or, another rule we have, if for some reason we have to file 3 evictions in a 12-month period for a tenant being, we file evictions on the 11th. So if we file an eviction 3 times on a tenant within a 12-month period, we don't renew to them again. So, but, again, it's few and far between, but sometimes, we don't renew to them for one reason or another. So.
Great. So my next question, and then I'll, open it up for everyone, and we can maybe talk about some fun stuff like interest rates and what's going on there and et cetera. Obviously now you guys are growing this portfolio. So we have a Sunday mastermind for guys, Garrett, Lloyd is on it. And like this past week, we talked about like opportunity cost, which is an important part of investing. And, even in a passive investing portfolio, obviously it's great when some of these deals go full cycle, you get your cash back, but then, what do you do with it, right? Uh, so now, for instance, like Carolina Commons, now the cottages, that's a deal that's been doing great. Like, when do you start to look at, well, maybe this might be time to sell, but also, what goes into that? Because perhaps you don't want to. It's doing great, it's doing well, and then what do you do with the capital that you return?
Yeah, so we kind of talk about this all the time, and uh, essentially we try to make decisions in terms of what's best for our LP investors. So, for example, the cottages at Staunton Bridge, we paid 2.7 for it. I would say conservatively, even at a 6.5 cap, it's now probably worth 4.7, 4.8, little over 100 a door for 2006 units. So the GP promote would be fairly significant if we sold it. But we've got 3.86% fixed rate debt for basically another, how long have we been in that? It'll be 25. We basically have, what's that, 5 years we've been in it now? It's going on 5?
Isn't it 3 years left?
Yeah, we've been in it. Yeah, 2021 we bought it. It's 2025. We've gone 4, so we've got 3 years left at 386 fixed. And so our assessment is, if we sell, what are the investors going to do with the money? Right now we're paying over 10% cash on cash, and we could certainly pay more. So on most of our early purchases, we have fixed rate debt around 4%, either high threes or low fours. Maturities typically another 2, 3, 4 years. And we actually have one deal that's got 7 more years at 3.85 from the Bank of Travelers Rest. So it's not in the interest of our investors to sell now. I think the decision point's going to come when the 1 year before the maturity occurs. We're going to have to start looking at that. And I think Dan, Brian, and I are primarily, I would say, philosophically long-term buy and hold investors. And so a lot of these assets we really like quite a bit, and they're performing. So when the note becomes due, we'll have to evaluate refinance and what rate we can get. We could evaluate sale and see what kind of price we could get. I think since we do smaller deals and maybe typically have 30, 40, 50 investors, I think there'll even be an option if we want to continue to hold the asset after refi. We can kind of pull our investors, and those who want to be cashed out, we probably can accommodate those who want to be cashed out. Those who want to stay in the deal longer could probably stay in. So that's how we kind of look at it. And with 4% debt in a 6.5% market, I don't think there's much we could do right now. Now, if rates drop to 4.5, 5, then we may start having some decisions to make. So I don't know, Dan, Brian, you could chime in on with your thoughts.
Yeah, I would just add that it certainly is going to be market dependent. It's a soft market right now, right? And so if in a year or two, things bounce back, rates come down, and cap rates go way low to where they were a couple years ago, where people were buying stuff at a 4 cap, then it may be just that much. It may be so enticing to sell at that point because of the profit potentials for everybody. But we're not in a seller's market. We're not in a market that's hot, right? So we're in a kind of wait and hold and see kind of market. So Fortunately, we have fixed rate debt and we can hold and just cash flow it until the market potentially improves, right? Or we decide to refinance. So there's various different decision points.
And at the end of the day, we'll try to accommodate what our investors want. So if people do want out, I'm sure there's a mechanism that we can kind of do that. On our newer purchases, say the new build stuff, the debt's about 7%. And the property's cash flowing, we put a fair amount down, probably 45% down to make that all work. Uh, and so hopefully rates will drop, and then that will probably offer an opportunity to refinance. And again, with the new construction, in my mind, sitting here, holding those for about 10 years might be the sweet spot before you kind of have significant maintenance. You should be able to get 10 years out of an HVAC and a roof and so forth. So I think 0 to 10 years repairs and maintenance should be fairly minimal. So I think with those are kind of longer term hold. But since we put significant cash down and we're at 7, those might offer an opportunity to refinance at some point and either return capital to the investors or increase cash flow.
Great. I have a question here from Anthony. And actually before I read, because it's about his is for Brian. Do you notice a lot of new to the area out of state looking to rent or more South Carolina born?
Yep. So good question. And I would say in the 16 years we've been in business, it's been a steady flow of out of state tenants coming in. I don't know the exact percentage. I can tell you, like, as you would suspect, there was definitely an uptick for a couple of years around COVID, but it's been from the day I started this business, there's always been a pretty heavy percentage of out of state tenants. I mean, we even have like a whole we have some procedures that we use for people moving out of state that haven't seen the house because it happens so often. We actually years ago came up with kind of some different procedures to before we get deposits and whatnot. But yeah, I mean, which is just like a testament to Greenville's growth over the years. I mean, we're just constant. It's just never ending. Just people moving here from out of state. So answer is yes, and it has been that way for years.
And I would say most of us are kind of familiar with U-Haul moving stats and stats about in-migration. And South Carolina is right up there with Texas, Florida, and North Carolina. And then when you consider South Carolina is probably a quarter of the population of Texas or Florida, the percentage in migration is pretty much off the charts. So yeah, the population influx is pretty amazing. And yes, there's a lot of new construction on. We recently bought a 38 unit building in a kind of workforce, lower income area, the flats at Old Buncombe in Sans Souci. And I was out there today. There's a project a half mile away, Union Bleachery, $2 billion project. They are actually starting to get ready to build $2 billion. It's going to be a 5 to 10 year build out. They've taken a lot of these mills and turned them into apartments, but also retail, restaurants, etc. And so I was excited to see that they're actually kind of breaking ground on this Union Bleachery site, which is literally a half mile from these flats at Old Buncombe that we bought. So I think the growth's continuing. My own sense is we may have a little oversupply of Class A stuff, but that's not the kind of property we typically buy. So we're not directly competing with them. But it's still impressive the amount of capital that's pouring into this area. And then, of course, the other area of South Carolina that's booming is kind of Myrtle Beach and Charleston, Summerville. So those two areas, it's kind of off the charts. So we think we're in a good spot.
Yeah, I mean to add a little bit of personal perspective, I was kind of when I saw that index, I was patting myself on the back a little because when I first started, I think like my natural instinct, you're looking at all the metrics, and I originally were looking at kind of where Dan lives, that Raleigh area, and quickly realized like everybody knew about that. It's not a secret, and that's kind of how I bumped upon South Carolina, which you can see the trend was growing, and there was reasons for that growth, and it's kind of amazing to see how much in the last few years, and I think obviously uh, COVID and remote work has helped a lot. But look, Ted, you're a guy that moved down. Technically, you're in South Carolina. It's very interesting, that Myrtle Beach area that Arn mentioned. And then last trip I went to Charleston in August. I always loved talking to Uber drivers and things like that because they kind of give you so much perspective. These were people who actually came from Florida and other places because they were priced out, and it's like, this is crazy. Like, so you have this convergence of North coming down there, also people getting priced out of Florida. So there's a lot going on.
And I think I recently saw a stat where somebody calculated what a family of four needs to make to have a decent life. And, California, New York, it's about 185, 200 grand a year to have a decent life for a family of four. South Carolina, it's about 90,000, and South Carolina was certainly at the lower end. So there's affordability issues driving it. And compared to the major metro areas on the coast, there's a stark difference. And that's not to say Greenville's inexpensive. It's not inexpensive. And people who could pay a little bit less are moving into areas outside Greenville, 10, 15, 20 miles, because downtown Greenville itself has gotten fairly expensive. So it's just kind of interesting to look at the differential in the cost of living and what kind of that means for people.
Before I throw out this one last question, kind of move things towards a little bit more of the market outlook for you guys, and the bigger picture. But just to answer that, like that was actually when my trip to Charleston was a little bit surprised, like how I'm not surprised, but it was if you want to live within 20 minutes of going downtown and the airport, it was pretty expensive. And that's a little bit shows. I think it probably wasn't like that maybe 5 years ago, but it just shows how the growth is. So kind of want to take the conversation a little bit towards, more of the macro look, and then hopefully, anyone else who has questions. Today, obviously, like, the Fed came out, rates were held. That was no surprise. It's something we talked about. What was the phrase? Everybody was like, stay alive to 25.
Survive to 25.
Yeah, survive to 25. Yeah, so I think it's interesting because maybe in the multifamily space in general, but here we are in 25, and I think it's probably starting to sink in this wait and see behavior that interest rates are not going anywhere. Yeah, this is where we are, and we're gonna have to live in this. I kind of would like to get your perspective on that, and then at this level of rates with other rising costs, labor, et cetera, insurance, we talked about, like, how does that affect deals when happening? And there's always been this talk about distress, but is there, we haven't seen that for a lot of reasons because people just sit and hold, but interested to see what you think about, in terms of trading properties now that people may have just realized like rates are here to stay.
Yeah. So I think right now we have 3 LOIs out, and we're not going to get any of them. There still seems to be about a 10% differential between what the seller wants and what we're willing to pay. So it's hard to pry Greenville property loose from these owners. Uh, so I'm not seeing a lot of panic and distress. There may be some, maybe at the bigger type properties in perhaps other areas. Uh, but those are going to be picked up by people who could write 20, 30, $40 million checks. They're not going to be $2, $3 million deals. They're going to be $40 million loans where the bank says, write me a check for 35 million so I can get this deal off my books. So we haven't seen a lot of distress. We look every day, we make offers, and it's hard to find one. We went after some pretty encouraging property in kind of an upcoming area in Spartanburg. The owner's 84. You figure he might be ready to sell. Ultimately, he just decided, let my kids inherit the property at a stepped up basis. If they want to sell it, no capital gain. So we were kind of hot, and we would have really liked to buy that property, but ultimately the owner, who's 84, just decided to hold it. And I can understand why he did, because it makes more sense to let his kids inherit it at a stepped up basis with no bite from the tax man. So I'm not seeing a lot of distress here in Greenville.
Yeah, and what Orange described is a very typical scenario. A couple times a week, we're looking at properties that almost the same story, especially from the brokers, right? They want 110, 115. It's worth 100 in today's market with the current debt. So we continue to look, but there's not a lot of compelling deals. Obviously, the new build stuff's a little different because the builders want to build, so we can lock in a price that makes sense. That's not like somebody needs to sell something. They want to build. They want to keep their crews, going. They want to maybe they'll make a compressed margin, but they still want to build for a margin. So we have some hopes that maybe we can make some new build stuff happen. But for the used product around, it's just most people aren't willing to sell it right now at a price that makes sense at 6.5%, 7% debt. So yeah. I mean, the last thing I say, we'd like to do more deals, but if they're not there, I mean, I think we're probably happy. We looked at some stuff maybe a couple of years ago that we were close on, and for some of those, we're probably glad we didn't get them because they were tight and rents have softened and so forth and so on. Obviously, we also don't buy with variable rate debt. Not to say we never would, but we haven't, and that's how a lot of people got in trouble, right? They want to buy a lot, and they get the highest leverage with the variable rate bridge debt, and there's a lot of extend and pretend, and we'll see what happens with those. But I guess we're happy that we didn't buy more than what the market supported, right?
And the other thing that I see, that we see quite a bit, is this. It's the same property the seller's been trying to sell for 2 freaking years. And 3 or 4 brokers have brought it to us, and Brian and I have gone look, and they'll call me, oh, we got blah, blah, blah. We go, we've already seen it. We know what the price is. And the price never comes down. They're still wanting that price they wanted 2 years ago. They haven't sold it. And you'd figure maybe they would go, maybe the market's speaking. But so we seem to get a lot of property that the seller's been trying to sell for 2 years, and they have a certain price in their mind, and the price doesn't make any sense, but they don't seem to be on the verge of losing it either. So they just kind of muck along, and it'll probably be on the market a year from now too.
We still think there might be some needles in the haystack. I mean, the last deal that Arm found, right? The Bunkum deal that he talked about. I mean, that was a great cost basis. Seller financing at 5% really clinched it. So it's possible to find deals at the right terms, but it's not easy, right? And the brokers aren't the typical brokers aren't sending you those kind of deals. These guys have to be resourceful and digging up these deals. So
yeah.
Any questions for anyone out there? Don't be shy. Jump in there.
Yeah. Could you guys go over briefly your buy box today for what you're looking for and deal size?
Yeah, so I would say it's Greenville County, maybe a little outside Greenville County. Uh, we don't want to have to get on 85 from downtown Greenville to get to the property. So we're not buying Anderson, we're not buying Spartanburg. So it's pretty much Greenville County, which might be Simpsonville, Fountain Inn on the south, up to Greer, Travelers Rest on the north. We'll go a little outside the county boundaries, provided we don't have to get on 85. And then I would say within that geographic box, we'll buy anything in 20, what was it, 2023, we bought 7 units in downtown Greenville. So uh, we'll buy small. Legitimately, I would say we might feel comfortable up to about 7, 8 million, which at 150 a door is whatever, 75 units. I can't do the math in my head. So I think sub 10 million, probably our sweet spot is 5, 6, 7 million. And we don't care whether it's new or old. It's just more, does it make sense as within our geographic boundaries?
Gotcha.
Yeah.
And if I could, one more question for you guys. The build to rent new construction project that you guys did. I know you mentioned they were more in like middle to lower income areas, if I'm not mistaken, or middle of the road.
Yeah, so I wouldn't say they're in low income areas. The rents we're getting on those are 14, 1500. Uh, Median county income in Greenville County is about 85,000, which would mean affordable rent might be up to about 1900 to 2000. So I wouldn't say these are low income. Taylor's is maybe 10 miles from downtown Greenville. It's where Brian lives. Uh, I think median household income in that neighborhood was close to about 90. The other new build in Lyman, which is above Greer, that's probably our most rural purchase. But even there, median household income is probably 85. The properties in Easley's a little bit more blue collar, a little bit more workforce than Greenville. Median household income there is 50 or 60. But I wouldn't describe it as low income. I describe it more as kind of middle income, uh, maybe not quite professional, but gainfully employed and doing fairly well. So Easley is booming. It's about 10, 15 miles west of downtown Greenville, maybe another 20 or 30 to Clemson. And it's booming. So we like Easley as a future growth. But I think we kind of are middle income, class B type property, even though they're new. I could describe them as kind of class B.
Yeah. My question would be like, what was that leasing process like? You're kind of in the middle, because there's so much class A out there being built. You guys, are kind of in the middle of the road location, but you're offering a brand new product. So like that leasing process, were you guys getting like an abundance of overqualified people that maybe want to live a little further out, but they're getting, new product, or were you getting maybe, an abundance of people that were underqualified, but they just love the new product in their neighborhood?
Yeah, Brian, maybe jump in.
Yeah, so like talking about over at Walford, no, definitely not a bunch of. I mean, if they were underqualified, they wouldn't be living there because we wouldn't approve them. So because we're
Yeah.
pretty strict on our application approval process. But no, actually, and I wouldn't say they were like grossly overqualified either. But I mean, yeah, we have like a solid tenant base over there. Like Arn said, I live here in Taylor's, and I mean, I can be downtown in 20 minutes from my house. And
Yep.
I love downtown Greenville, but I'd rather live here. It starts to be
Yep.
tiny bit more rural out here where I am, and Walford is about 5 minutes from my house, and it's even more rural there. Um, and not everyone wants to live in downtown Greenville. There's tons of people that want no part of living in downtown Greenville, actually, or can't afford it. And I really find I've for years and years and years, like all the stuff, all the rental properties my wife and I own, they're all like either super high C class or B class properties. So even though this is new construction, this isn't class A with all these high end amenities. This is just solid rental properties. And I'm just a huge fan of like B class properties. I feel like it's the sweet spot, right? And yeah, no, we've done really good out there in Walford, and uh, got some really good tenants. So it's, to me, that's a good price point where you're not going to get like the issues that you get with like the lower D class properties, right? Years ago, we managed a bunch of that stuff, and we really got out of it as much as we possibly could over the years, because it's just, the juice isn't worth the squeeze on those types of properties, in my opinion. It's just such a major headache. But again, these like B class properties, for the most part, you end up with some really good tenants. They're actually, like, for the most part, taking good care of the property, paying their rent on time, that type of thing. So that's more like what Walford is.
And the same, I would say it's similar out in Easley, and it's
Yeah,
similar in Lyman, right? It's not that
exactly.
big of a difference.
Yeah.
And I think the other thing, these are for people who have a dog, who want a little yard. They don't want somebody living above them. They don't want, neighbors on both sides. So I think in these new build, which typically are 2-story, 2-bedroom, 2.5 bath units with one common wall, or out in Lyman, they're 1-story, 3-bedroom, 2-bath units with one common wall. That's a little bit different tenant than who wants to live in an apartment building downtown. And I think the other thing we've seen in multifamily across the United States, generally the Class C tends to be struggling a little bit more. And I would say those people are just a little bit more marginalized economically and struggling a little bit more. Uh, and so if you can get a little bit above that, maybe a little bit more stable employment, little bit of savings, residents who, if they have a $500 car repair, can still pay their rent, where with many people, they got a $500 car repair, they're not going to be able to pay the rent. So that's kind of what we target. And I can say, in my experience in real estate, the rent to price ratio, as the price gets more expensive, either for a house or an apartment unit, the ratio between rent and price gets smaller, if that makes sense. Right. So the differential as you go up in the price range gets bigger. And so it's a matter of kind of finding that sweet spot where you got a good rent to price ratio, but still good performance in terms of payment and so forth.
Thanks, guys.
Yeah.
Appreciate it.
Thanks, Miguel. Yeah.
Thanks, Garrett. So we are at the hour mark, and I want to keep just be respective of our and Brian's and Dan's time here. So one last question here for you guys from Mike, which actually gets into the C class, D class. If the rate environment does become more favorable and prices continue to rise as a result, do you see affordability issues pushing demand in class C and D, where investor competition is crowded, and what's your hedge in that case?
So is the question, if rates drop, then the buying of apartments becomes more competitive?
Yeah, so the question really is about the renter affordability and what happens to the price to renter ratio, like you just talked about, where that gap starts to become a little bit bigger because rents have kind of plateaued in a lot of areas down in the southeast. And so, with a more favorable rate environment, you'd expect that the investors who are waiting on the sidelines for exactly that to happen is going to push prices even higher. And so you had talked about, looking at markets a little further away from downtown Greenville because, this is kind of where you could get the same Class B type property for a little better of a price point. But ultimately, there's only so far away you can move from Greenville Center. So, I mean, would you guys as an investor team, I mean, I know your specialty is kind of the build to rent Class B product. Have you considered, or are you considering, a hedge to that strategy, or would you look to a location where that strategy would continue to work out for you?
Yeah,
Sorry for the long-winded question.
Yeah, no, no, no. So, I guess I have a personal bias for more the infill location than the sprawl, if that makes sense. And generally, what I've experienced is the better locations appreciate more when the market starts to turn, and go up. And then I think the other thing is the property management's very important to us, and Brian does a great job on it, and he has a system and has employees and kind of has a geographic margin, geographic range. And for us, that's a very important criteria. So I don't know that we'll ever expand much out of Greenville. And I think it's more driven by the importance of having excellent property management. And like I've looked at other markets, and while they may be appealing, what I'm always up against is, okay, who's going to run the day-to-day operation? And for me, I'd rather not kind of take that chance. We kind of have a market, we know what we're doing, it's working well. And since we don't have any big desire to become a huge syndication firm, I think in general we're kind of content on doing what we do. And if it only means 2 or 3 deals a year, that's fine. That being said, there are a lot of people who are totally gung-ho on Spartanburg 45 miles away from Greenville. And I think there's some rationale at that. On the other side, another 40 miles to the west is Anderson. And I think ultimately Anderson's going to boom. So I think there are some investment opportunities outside Greenville. But you got to have the right team to kind of execute the game plan. And so that's my personal hesitation to kind of expanding. I'd rather just stick with what we know and that we think we do a pretty good job on. I don't know if that answers your question, but
Absolutely does.
Mike, I can take another quick stab.
Okay.
It seems like you may have also been asking, are we interested in C and D class? I mean, several of the projects we recently closed were the new build to rent stuff, which is solid B, right? But the old Buncombe project that we just closed on last year, that's C minus. We're gonna take that up a notch, improve the product. So we are interested in those properties. In fact, Arn's got several LOIs out that he's mentioning, and those were like C class properties, $900 rent, $1,000 rents, over 70s and 80s products. So we are interested in that. It's still hard to make those deals work. But I think maybe one of your points, interest rates aside, you can't build new product to accommodate the workforce housing, right? Because it just costs too much.
Right.
So the only place that these people, the workforce needs to live is older product, and there's a limited supply in Greenville and other cities. So I think we do see potential there, and we are making offers on those type of properties. And Brian's team has a lot of experience in rehabs and heavy value adds. So we're looking at those things. So irrespective of interest rates, if we can find something in pencils that makes sense, like the Lodge project, and we've made offers on other projects, if it's C and D class housing, we're not opposed to that. So we were fine with a portfolio of new build product, C, D, kind of everything in between. I don't think we're going to compete for A for the reasons that we've been cited, but we certainly aren't interested in C class housing if we can find it where it makes sense to pull the trigger,
Yeah, Dan, thanks. And so like with old Buncombe, we paid basically 60, 65 a door. Average rent was about 575, and we knew that was below market. We really think market rent's probably like 750. And we got owner financing. So 580 current average rent, paying 60, 65 a door with 5% owner financing, knowing we can get a bump of 100, 150 without even doing anything. That makes sense. Unfortunately, what we see a lot on the Class C and D is somebody wants 120 a door for a unit that's renting at 950. It's just hard to make that work. And the other thing is basically unit turns now are what, probably $7,500 minimum, maybe to 10 for just scratching the surface. So we really need for the value add to really almost meet that 1% rule. And so we're good with it, but most people won't let it go. And what I would say is most of those owners maybe have 4.5%, 5% debt. And so we'd have to pay 6.5. The property's worth more to the existing owner than it is to us. So that's why it doesn't trade. So I think that's kind of the other problem.
Great. Thank you,
Yeah.
guys.
Yeah. Thank you.
Well, guys, I appreciate it. This was really, really good. If anyone has any additional questions, feel free to reach out to Arn, Ryan, Dan, myself. I have the information. We'll get to you. And thank you. And really good opportunity to just kind of pick the brains of operators that are making things happen in Greenville. So I appreciate you guys coming on and everybody else adding to this discussion.
Yep. Thanks, Jerry. Thank you to you all. Thank you.
Yeah, thanks, Jerry.
All right. Good night, guys.
Thanks, guys.
Yeah.
Have a good night.
Bye-bye.